Yes, guys. So what makes the best estimate of your value in use? You're talking about estimated cash flows. You're talking about multiple estimates. Now, what is the basis of these estimates? The basis of these estimates are nothing but the projections or the financial assumptions which the management takes. Now, the management does prepare their budgets and forecasts, correct? Every management does prepare their budgets and forecasts. Even the smallest of the enterprise prepares its budgets and forecasts. For example, you take my firm, I prepare a budget for what is the next month expenditure. My next month expenditure could include my salaries, it could include my refurbishment of my certain laptops, it could include my rent, it could include my electricity, it could include my office maintenance, it could include a lot of expenses 1, 2, 3, 4, 5. A small size of team which I have is about 23 people. In that 23 people, I have an estimated cost. I try to make an estimate of the total cost of my office, and I'll say that this total cost, how do I recover the cost? So that means at least my collections from customers from audit and other professional services should at least meet this particular cost. So this way I try to budget it. So this budgeting in a bigger enterprise doesn't happen for monthly basis. I, being a very small CA firm, I might be probably giving only monthly estimates, but a larger enterprises could tend to give budgetary estimates for the future periods as well. And they can give a forecast for the next future years. Now, these budgets and forecasts should be the primary basis for estimating your cash flows. Number one. Number two, these budgets and forecasts should be based on certain reasonable assumptions which the enterprise makes. Enterprise is estimating to get 30% production, 50% current production, third year 100%. Not reasonable. So you will have to basically determine what is reasonable and what is not. And these management estimates should be based on reasonable assumptions. Third one, you cannot make an assumption. You cannot make an assumption or a forecast for more than 5 years. This 5 years term or the maximum period for this projection is an accounting estimate. You can make a reasonable accounting estimate only for a period of 5 years. Beyond 5 years, if you make an estimate, it is unreasonable. Even when you apply for a term loan for a bank, you normally prepare financial assumptions and financial projections. These financial assumptions and projections are generally made only for a period of 5 years or up to a maximum of 7 years. Beyond 7 years, no one will consider your estimates. Because beyond this accounting estimate or a reasonable accounting estimate up to 5 years, any other estimate is considered to be unreasonable because it is not in near future. But let's say the useful life of the asset was 15 years and not 5 years. How can I make an estimate only for 5 years cash flow when the useful life of the asset is 15 years? In such cases, I will have to apply a reasonable growth rate. I'll have to apply a growth rate starting from year 5 up to year 15. What is this reasonable growth rate which I have to consider from year 5 to year 15? The reasonable growth rate considered is generally a steady growth rate or a declining growth, unless an incremental growth rate can be justified. Unless you justify an incremental growth rate, it is always reasonable to consider a steady growth rate or a declining growth. Guys, it is a growth. So I expect that the cash flows derived from this asset are continuing to grow at a steady rate of 5% every year. Fine. I expect that the growth rate starting from year 6 onwards is 5%, 4%, 3%, 2%, 0. Fine. Decreasing growth rate. I expect that the growth rate from the cash flows derived from the use of the asset starting from year 6 is 5%, 6%, 7%, 8%, 9%, not possible. Not possible. Incremental growth rate is only possible to be considered if such increase in the growth rate is justified. That means you should have sufficient facts of the case which will justify that the incremental growth rate can be considered in estimating your value in use. Clear? So these are some reasonable basis on which we estimate our cash flows which are utilized in computation of value in use. future cash flow estimates. Your future cash flow estimates should be based on the management projections and budgets. First point, be based on management budgets and forecasts. These management budgets and forecasts should be based on reasonable and reliable assumptions. They should be based on reasonable and consistent assumptions. Certain financial assumptions have to be made. I said the selling price in the previous example, I said the selling price is estimated to increase with an inflation rate of 10%. That is a reasonable assumption. Number 3. Estimates can be reasonably made. Only for a period of 5 years. Period of up to 5 years. Up to 5 years, you can make a reasonable estimate. But if the useful life of the asset is beyond 5 years, if the useful life of asset is beyond 5 years or greater than 5 years, in such cases, what should I do? When the 5 years, when your useful life is more than 5 years, but you can make only a reliable estimate only up to 5 years, then beyond 5 years, in year 5 onwards, cash flows should be computed using steady or declining growth rate. Steady or declining growth rate unless an incremental growth rate is justified. Four points are written. Please understand each one. You are saying you can only make a reasonable estimate for cash flows arising from the continuing use of the asset for a maximum period of 5 years. What if the useful life of the asset is more than 5 years? If the useful life is greater than 5 years, then year 6 onwards, my cash flows will be estimated based on a steady or a declining growth rate, unless an incremental growth rate is justified. Here, this is how we make estimates, guys. Our estimate should only be based on management assumptions, on management forecasts and budgets. These forecasts and budgets which the management has made, you make sure that they are based on reliable and reasonable assumptions which are consistent. Make consistent reasonable and reliable assumptions. These estimates, which are based on reliable assumptions, can only be considered for a period of 5 years. You cannot take these estimates beyond 5 years period. But however, if the useful life of the asset is greater than 5 years, then from 5th year onwards, the cash flows should be based on either a steady or a declining growth rate, unless an incremental growth rate can be justified. Here, this is what our understanding is as far as your value in use is concerned. So whatever we have discussed so far, present value of cash flows, inclusions in cash flows, exclusions from cash flows, what is your estimate of discount rate, how do we identify the present value of discounted cash flows, what is the terminal cash flow derived from the sale of the asset at the end of its useful life, and how to make these estimates. We have discussed all this. So that will be a consolidated discussion, an amazing discussion that we had as far as estimating your value in use is concerned. Estimating your value in use is concerned. But another peculiar circumstance arises. It's not easy always. There will be peculiar circumstances which keep on cropping up. One peculiar circumstance such emerges when an asset particularly generates cash flows in foreign currency. An asset is only deriving cash flows in foreign currency or is estimated to derive cash flows in foreign currency. Same logic you apply. This particular asset is deriving or is basically producing units of a particular product. These units of particular product are only sold outside India. Let's say easier case for the to the enterprise in US. These enterprise in US are only deriving or we are only generating cash flows in US dollars. So I collect US dollars. Year 1, I am expecting to collect 65,000 US dollars. Year 2, I am expecting to collect 82,000 US dollars. Year 3, I am expecting to collect 1 lakh US dollars. Year 4, I expect to collect 1,14,000 US dollars. Like this, you have estimates. Okay. Now, however, when you look at the carrying value of the asset, it is in rupee terms. It is absolutely in rupee terms, your carrying value. You cannot compare with the recoverable amount which is calculated based on value in use in dollars. How can you compare rupee and dollar? Not possible. Therefore, these foreign currency cash flows which are generated have to be converted into functional currency or a rupee term. I used a word called as functional currency. I'll talk about it in discussion of IND AS 21. But the term which I use is 100% right. It is called as functional currency. Now these amounts which are derived in foreign currency have to be converted into functional currency to arrive at what is the recoverable amount or the value in use, and then compare with the carrying value to determine whether there is any impairment to the value of the asset or not. Now how do I convert these foreign currency cash flows into functional currency of rupee? And you'll say, what is there, sir? Apply exchange rates. So simple. Answer is apply exchange rate. Once again, my future cash flows in rupee, in year 1 I will derive certain dollars. Year 2 I will derive certain dollars. Year 3 I will derive certain dollars. If I am talking about the future periods, future exchange rate, do you know? Unless or until I am an astrologer, it is not possible for me to estimate what are the future exchange rates. The future exchange rate, today's rate might be 73 rupees or 74 rupees. In future, I might estimate that it could be 80 rupees, 85 rupees or 90 rupees. Or it could fall down to 38 rupees, 40 rupees, 42 rupees as well. I have no idea what is this future exchange rate. So when I don't know future exchange rate, how can I convert them into rupee? Then you will say, sir, easy. Spot rate you take. Spot rate is today's rate. You cannot apply it to year 3 cash flow, year 4 cash flow, year 5 cash flow. Those cash flows, if you convert it using a spot rate, it is not logical. There is no logic apply. Today's exchange rate, year 3's cash flow. How will I apply? How will I apply? The appropriate exchange rate is that particular year's estimated exchange rate. Estimated exchange rate is not possible here. estimated exchange rate on reasonable basis cannot be derived. Therefore, for such kind of assets which are generating cash flows in foreign currency only, we will have to understand what could be the discussion possible. Let's go back. Asset which is generating cash flows in foreign currency. If an asset starts generating cash flows in foreign currency, then how do I estimate the value of the amount of value in use? Let's say I have something like this. Here, again, useful life is 5 years. Let's take 3 years. Ease of calculation. Cash flows estimated to be derived are, let's say, $65,000, $87,000, lakh, and $12,000. If I have cash flows which are denominated like this in dollars, what should be the rate which I have to apply so that I will be able to convert this into cash flow in rupee terms? These exchange rates, future exchange rates. So I cannot have here in year 1. What is your exchange rate in year 2? What is your exchange rate in year 3? This I cannot estimate reliably. These exchange rates cannot be estimated reliably. In the same way, I cannot even take the spot rate. Spot rate or spot exchange rate is also not possible. Spot rate is also not reasonable. Then how do I identify cash flow in rupee? Can I identify cash flow in rupee? Answer is no. You cannot identify cash flows of each year in INR. When you cannot estimate cash flow in INR, then how will you calculate the value in use? Value in use should be in INR. Can I estimate value in INR? Not possible. So that is the reason why I need a specific discussion on this. For such assets, now understand what I say. For such assets, apply the foreign currency discount rate. Foreign currency discount rate is different from INR discount rate, guys, because each currency have their own time value of money. Apply foreign currency discount rate. Based on the foreign currency cash flows and foreign currency discount rate, determine value in use in foreign currency. You are determining value in use in foreign currency based on foreign currency cash flows, foreign currency discount. value in use in rupee terms or in functional currency is equal to VIU in foreign currency multiplied by spot rate. Now you will come up and say, 1 second, you said spot rate is not relevant. Again, you are multiplying it with spot rate only. What logic are you talking about? I said, you cannot take spot rate in converting the future currency cash flows into INR. You cannot apply the spot rate, the exchange rate on today's date, to convert the foreign currency cash flow into INR. But however, once you have identified value in use in foreign currency, such value in use in foreign currency is today's value. It is today's value. If I find today's value in foreign currency, I can apply it with a spot rate or I can multiply it with a spot rate and I can determine value in use in INR or your functional currency. This is a very, very peculiar nature of value in use, and believe me when I say this, these things have been tested in the exam in the past. They are tested in the exam in the past. So this is a very peculiar discussion that we are having, and remember, this is one of the most important discussion which goes into value in use. So I am saying, if an asset generates cash flows in foreign currency, if an asset generates cash flows in foreign currency, those future cash flows in foreign currency should be discounted using a foreign currency discount rate. By applying the foreign currency discount rate on foreign currency cash flows, I will be able to derive what is value in use on today's date. Value in use in INR, I will be able to derive. These value in use in foreign currency, I will be able to derive. This value in use in foreign currency, when multiplied with the spot rate, it will give me what is the value in use in rupee terms. Here, this is fundamentally at large a very important discussion that we had as far as your assets are concerned, which are deriving cash flows in foreign currency. Clear? That will bring us to the end of discussion regarding your value in use. So we discussed recoverable amount. We have discussed net selling price or fair value less cost to sell. We discussed value in use. Therefore, we have completed the discussion regarding measurement of your impairment. Once you are done with your measurement of impairment, we should start looking at recognition of impairment loss. And remember, the recognition of impairment loss is a very, very, very small, simple, concise discussion as far as the individual assets are concerned. I'll bring out a very, very important concept towards the end of the recognition, because this what we have discussed is only half of the standard. This what we have discussed is only half of the standard. Because from here on, you have very significant discussion as far as your measurement and recognition of impairment loss in certain other situations as well. What are these other situations? Why do they arise? We will talk about that.